Now let's talk for a few minutes about job costing and spoolage, as well as a few other items such as how do we go about accounting for scrap. In regards to our jobs, we may also have spoolage. We may have normal spoolage and we may have abnormal spoolage as it applies to job costing. Abnormal spoolage is treated as a period cost, as an expense of the period in which it occurs. In regards to normal spoolage, however, we want to calculate and figure out whether that normal spoolage is attributable to a specific job or whether that normal spoolage is attributable to all jobs, or it's a common normal spoolage. So normal spoolage attributable to a specific job is bared within the cost of that job. However, we can subtract from that cost the amount of money that we can get when we sell that spoolage, if it is possible to do so. So depending on what the item is and if there is a value of some sort on a market for it, we can reduce the cost of the job by the value of those normal spooled units, that disposal value. If we have normal spoolage that's inherent in our job processing and it's common to all the jobs, then we are going to put that into manufacturing overhead and allocate it to all the jobs. When we do our budgeting process, we are going to make some calculations in regards to what we think our normal spoolage will be over our time frame common to all jobs, and we would include that number in our manufacturing overhead estimate for the year, and it will be included in our allocation throughout the period. If we have abnormal spoolage, again, it's a period cost. It's going to be showing up on our income statement. We're going to debit that account called loss from abnormal spoolage, and we're going to highlight that to management and production and engineering and see if we cannot find out what our root cause is and continue on with that continuous improvement initiative. In regards to rework, again, what is our rework? Rework is when we have units that have been inspected and found to be unacceptable. However, we take these units and we repair them and sell them as acceptable finished units. So, do we have normal rework attributable to a specific job? If so, then the rework costs are charged to that specific job. If we have normal rework common to all the jobs, then the costs are then again put to manufacturing overhead and spread throughout all the jobs via our overhead allocation. If we've got abnormal rework, then we're going to also charge it to that debit expense account, loss from abnormal rework account that appears on the income statement. So again, we want to highlight the fact that we've got a loss, but this time it's from abnormal rework, but it'll show up in that same area, and again, we want to highlight that with management. What if we have scrap? How are we going to go about doing that? Again, what is scrap? It's the leftover material resulting from manufacturing a product. I showed you guys the other day the circles with the paper and the leftover parts that had the circles cut out of them was our scrap. If you will, think also of a company that uses trees and they saw it into lumber. Okay, sawdust. Sawdust would be the scrap. Sawdust can be used for certain things, but it has a very low sales value. We could possibly sell it to somebody, but we're not going to get a lot of money for it. Planning can sometimes lower the amount of scrap that we accumulate in our process, but some scrap is inevitable in certain manufacturing processes, but we do need to go about accounting for the scrap. In regards to scrap, we've got two aspects that we need to consider. Planning and control of the scrap, which includes the physical tracking of the scrap that we have, but also inventory costing of the scrap, including when and how scrap affects our operating income. Because we might generate some scrap and we may be able to sell the scrap, but it could take longer to sell the scrap than how fast we could sell the jobs or the items that we process and manufacture. So in regards to scrap, typically no distinction is made between normal and abnormal scrap because no cost is assigned to the scrap. The only distinction made is between scrap attributable to a specific job and scrap common to all jobs. So planning and control, I've mentioned this already, and inventory costing. How do we go about handling those two issues? Many firms maintain a distinct account for their scrap cost, so they can see it on their financial statements. If we've got scrap attributable to a specific job and we are somehow going to get some revenues for that scrap, then we can actually include that in our specific job. That's only done when we can actually trace it in some type of economically feasible way. There won't be any cost assigned to the scrap. However, we are able to make some entries on our specific job and show that inventory. Let me go back to that slide for 1 second. One way of accounting for scrap is to recognize it at the time of its sale. So whenever we sell the scrap, we will not have maintained any type of inventory record for it whatsoever. But when it's sold, we would debit accounts receivable or debit cash, whichever way we're paid, and scrap revenues would be credited. However, if we have scrap and it has more than an insignificant value, then we would assign an inventory valuation to it, and it would be equal to its sales value, and that sales value dollar amount would be debited into a materials account, and we would credit it out of work in process or credit it out of manufacturing overhead. And then finally, when it's sold, cash or accounts receivable would be debited, and that inventory materials account would be credited and closed out. In regards to our scrap common to all jobs, all products bear production costs without any credit for scrap revenues except in an indirect manner. Expected scrap revenues are considered when setting is lower than it would be if the overhead budget had not been reduced by expected scrap revenues. Again, we may have a lap in time from when the scrap is actually generated in production versus when we actually sell it and receive revenues. So that kind of causes us some issues as to our financial statements. The firm assigns an inventory cost to scrap at a conservative estimate of its net realizable value. This was back to what I was talking about a few minutes ago, so that we can put that inventory, put that value on that scrap on our balance sheet, and those revenues will be recognized in the same accounting period. In regards to our normal and abnormal spoilage changes, depending on when inspection occurs here, I don't believe you've got a homework problem in regards to this, but recall that we were making the assumption in Chapter 18 that our units were inspected at the end of the process. If that is not the case and it's throughout that period of time at different points within the process, then that would change how we go about calculating our equivalent units, and we would have to add additional lines to our process costing form in order to be able to put those costs where they need to go in regards to those units. And that is the rest of Chapter 18. Work through your ICPs for 17 and 18 using those forms that I uploaded in the Excel spreadsheet. Again, make sure that you see that 17 has weighted in FIFO, and those have no spoilage included on those documents. And then the 18 versions have the FIFO and the weighted with spoilage. You can use those for your ICPs. You can even print yourself additional copies to use for when you do your homework.